bottom line, and then a pro to that too, is once you hit over that 12-month threshold, you're not getting taxed as ordinary income, which a lot of accreditors or credit investors are always looking to lower their tax bracket. You're being taxed as a capital gain.
How are you guys handling the exits when you get those? Are you guys getting taxed on that? Tell me a little bit about your exit strategy.
Well, that's obviously the name of your show is Capital Gains Tax Solutions. So for accredited investors, the beauty, well, let's talk about the cons. The cons, at least for alternative investments, the bulk of them, especially what we do over here at TSG, are the illiquidity. Sometimes investors should expect to be at least without that cash for at least 5 years.
Right.
But the reward could be, exponential. So the bottom line, and then a pro to that too, is once you hit over that 12-month threshold, you're not getting taxed as ordinary income, which a lot of accreditors or, accredited investors are always looking to lower their tax bracket. You're being taxed as a capital gain. So 99% of the time, once there is an exit, our LPs are being taxed as a capital gain, not ordinary income. So that's definitely a benefit. Especially during a traditional IPO, which has been the bulk of our exits, minus SoFi. We actually had that went public via SPAC. So the lockup wasn't. It went public, I think, in June, and we got access to our shares merely 2 weeks later. But typically, when in a traditional IPO, even because you invested in the private market, because of those restrictions, you can't sell your shares for at least another 6 months. So that's why we also, we've had a few situations where one of our portfolio companies goes public. You have that first day pop. It's up, 200, 300, 400%. LPs are calling in. They're happy. And my whole approach is a little bit more sociopathic, where when things are well, you don't want to overreact, because it's also going to protect you when things don't go the way you want. You're also not going to overreact. So I don't really care what it does on the first day, the first month, or even the first week for that matter, because we do have to carry out that 6-month hump once those shares are truly unrestricted.
Gotcha. So it's a nice little indication. Hey, this might do well. We're on the right path here, but hold your horses. Don't get too excited too quick, because until we get the ability to actually make the move, it doesn't actually matter.
Yeah, 100%. That's 100% accurate.
Cool. So when you have these liquidity events, right? I mean, since this is it, one of the cool strategies that we have is called the Deferred Sales Trust. Which, what's unique about the Deferred Sales Trust is you can liquidate the asset, and it doesn't have to be real estate. Unlike a 1031, it could be a stock, it could be a business, it could be real estate, primary home, it could be art, a racehorse. It doesn't matter. Anything that's highly appreciated. And what you can do is you can transfer the asset into an unrelated third-party trust in exchange for a promissory note. And then that asset is immediately sold when once the asset's transferred into the trust, it's immediately sold. And then the trust is funded. And what's going on is in that trust, you're having a deferral state. And then that money you can direct to basically reinvest into whatever you want. So you can go back into it. So imagine you have, right, a liquidity event, right, where you invested in the tech company, you put $100,000 in, right? It 10, 20x or whatever, right? It's worth $2 million. And now you're at this point where it's like, okay, well, that's a $1.9 million gain. Well, instead of getting taxed at, in California, it's going to be 37 to 40%, right? New York's probably similar, right? 40%, something like that, right? Instead of 40% of your gain going bye-bye, for taxes, you could actually take that and reinvest it. And so now you're playing with the full proceeds minus attorney fees instead of minus taxes. And so it's a fantastic way for you to continue to grow and develop your portfolio, right? Your wealth, accumulate it and preserve it, because through that note, you can do a whole bunch of different stuff. I mean, you can cash flow from it, you can reinvest it, you can put it into super conservative and stocks, bonds, treasury bills, or whatever, VCs. So as a financial advisor and as a alternative investment strategist, it's wonderful, because you get this ability now to all of a sudden, Johnny's got an extra, $500 million, $2 million, $4 million to play with that you would have had to shell out to Sleepy Joe over there. And so it's, it's way better in your hands, right, than their hands. So it gives you a huge bump, that 40% bump in your AUM, that you can go ahead and reinvest those proceeds into other alternative investments and manage those funds. So it's a phenomenal strategy for that.